Somewhere between a coin jar in a grandmother's drawer and a silicon wafer bound for a solar farm, silver has quietly become one of the most contested substances on the planet. This week, it broke $62 an ounce. What that number is trying to tell you is not what you think. There is a certain kind of asset that spends decades in polite obscurity, tolerated rather than admired, and then, with no ceremony whatsoever, forces its way into the conversation. Silver has just done this. It is worth pausing on how odd that is. This is not a young technology company promising a future that has not yet arrived. This is a metal humanity has mined, minted, and argued over for roughly 5,000 years, since the silver mines of Anatolia first taught the ancient world that value could be stamped onto something small enough to carry in a pocket. And yet here it is, in the summer of 2026, trading in the low 60s, having spent the better part of a decade being politely ignored by a financial press, infatuated with gold, technology stocks, and digital currencies that did not exist when most of today's silver mines were first surveyed. The historian in me finds this delicious. The investor in you should find it instructive. Because when an asset this old, this well understood, and this thoroughly documented suddenly becomes interesting again, the reasons are rarely trivial. They tend to be structural. And structure, unlike sentiment, does not evaporate with the next news cycle. Consider first what silver actually is, as opposed to what it is popularly imagined to be. Gold has the luxury of being almost entirely ornamental and monetary. It sits in vaults, is fashioned into rings, and is otherwise left alone, which is why the gold above ground today is very nearly all the gold ever mined. Silver enjoys no such leisure. A considerable share of the silver pulled from the earth each year is consumed, dissolved into solder, layered onto solar cells, etched into circuit boards, deployed in medical devices, and in many cases never meaningfully recovered. Silver, in other words, lives two lives at once: the dignified life of a monetary metal held by people who distrust paper promises, and the working life of an industrial input that vanishes into the machinery of modern civilization. That dual citizenship is the whole story, and almost nobody outside the trade properly reckons with it. The consequence of this arrangement is a market permanently haunted by the question of supply. According to the Silver Institute's most recent industry outlook, the global silver market is on track to post a sixth consecutive annual deficit in 2026, with analysts at Reuters estimating the shortfall at somewhere in the neighborhood of 67 million ounces. 6 years running is not an anomaly. It is a pattern, and patterns, as any actuary will tell you, deserve more respect than headlines usually grant them. When a market runs short year after year, the slack is absorbed by above-ground inventories, the metal already refined and sitting in vaults, ETFs, and exchange stockpiles. That cushion is not infinite. It can be drawn down for a long while without incident, right up until the moment it cannot, and the market discovers, usually all at once, that the cushion was thinner than assumed. Why does supply not simply rise to meet the deficit, as the tidy diagrams in an economics textbook would suggest it should? Because silver, inconveniently, is often a passenger rather than a driver. Data from the United States Geological Survey confirms what miners have long known privately. A substantial portion of the world's silver is produced not from dedicated silver mines, but as a byproduct of extracting lead, zinc, copper, and gold. A mining company deciding whether to expand a zinc operation is thinking about zinc economics, not silver economics, even though the silver comes along for the ride. This means the supply side of this market cannot simply be summoned by a rising price, the way a textbook would have you believe. Exploration takes years, permitting takes years, financing takes years. And a byproduct mine will not accelerate its silver output merely because silver, considered on its own, has become fashionable again. Meanwhile, demand pulls from an entirely different direction, and pulls hard. Silver possesses the highest electrical and thermal conductivity of any metal on the periodic table, a property no amount of clever engineering has managed to substitute away entirely. It reflects light with a purity that makes it valuable in advanced optics and solar cells. It carries antimicrobial properties that keep it embedded in medical technology. It is, in short, difficult to remove from the architecture of the modern economy, however much certain industries might wish otherwise. Solar manufacturers have spent years attempting what the trade calls thrifting, trimming the silver content per panel, and in some cases experimenting with copper alternatives. And even so, industrial fabrication is still projected to consume several 100 million ounces in 2026 alone. That is not a rounding error. That is a structural claim on a metal already running short. So you have, on one side, an investment community rediscovering silver as protection against a currency and a bond market it no longer fully trusts, a rediscovery that tends to accelerate once a price breaks a psychologically significant level, such as $62. And on the other side, you have an industrial base that genuinely cannot do without the metal, however much higher prices might sting its margins. Two forms of demand, pulling from different motives, arriving at the same counter at the same time, against a supply chain that moves at the pace of geology and government paperwork rather than the pace of headlines. That is not a coincidence producing a rally. That is friction producing a signal. Before we go further, I would ask you to do something almost nobody does anymore, which is to form an actual opinion and commit it to writing. Down in the comments, tell me plainly, do you believe silver's move above $62 is the early chapter of something considerably larger? Or do you suspect this rally has already run ahead of the facts that supposedly justify it? I am genuinely curious how this audience is reading the tape, because the answer tends to reveal more about the state of public confidence than any single economic indicator can. And if you find that this kind of sober accounting, the kind that resists both blind enthusiasm and reflexive cynicism, is useful to you, this is precisely the moment to subscribe to this channel, because the deeper and, frankly, more consequential part of this story is still ahead of us. The part concerning what happens when a market this tight meets a public this anxious, and why that combination has, throughout history, produced consequences that arrive well after most people have stopped paying attention. It is a peculiarity of markets that they rarely announce their intentions in advance. They do not send a memorandum. They accumulate pressure quietly, in inventory reports and mine-permitting delays and central bank minutes, and then one day the pressure finds an exit and everyone acts surprised. I would submit that silver, at present, is a market accumulating exactly this kind of pressure, and that the $62 level is less a ceiling than a pressure valve beginning, ever so slightly, to hiss. Start with the currency of the moment, which is not the dollar, but the credibility of institutions that manage it. The Federal Reserve, now under the stewardship of Chair Kevin Warsh, has spent recent months navigating a labor market that cooled more sharply than forecasters expected. June's payroll report showed job growth of just 57,000, well beneath consensus estimates and accompanied by downward revisions to the two prior months. Markets, reading tea leaves as markets do, have scaled back their expectations for further tightening, with futures pricing something close to even odds on the Fed's next major decision. This matters to silver for a reason that is often stated but rarely explained well. Silver, like gold, pays no yield. It sits quietly and does not compound. When interest rates are expected to climb, the opportunity cost of holding an inert metal rises with them, and capital drifts toward assets that pay something. When that expectation softens, as it has in recent weeks, the opportunity cost softens too, and silver becomes, relatively speaking, less expensive to hold than the spreadsheet suggested a month earlier. This is not mysticism. It is arithmetic, dressed up in the language of monetary policy. But interest rate arithmetic alone does not explain a metal that has gained roughly 2/3 of its value over the past year. Nor does it explain why silver, having touched an extraordinary intraday high above $120 in January of 2026, remains a subject of fascination even after retreating by nearly half from that peak. For that, you need to reckon with the older, less quantifiable force that has always accompanied precious metals through history. The recognition, however grudging, that paper promises occasionally fail to keep their word, and that something you can hold in your hand carries a different kind of assurance than something you can only read about on a screen. This is where I part company with those who insist that silver's rise is merely speculative froth, a story for gamblers rather than serious people. The gold-to-silver ratio, the number of silver ounces required to purchase a single ounce of gold, has spent much of the past several years elevated well above its long-run historical range of roughly 40 to 60, at times drifting past 70 or even higher, before compressing meaningfully as silver's rally accelerated. A ratio persistently stretched beyond its historical norm has, across more than a century of data, tended eventually to snap back toward it, sometimes gently and sometimes with considerable violence. Whether that reversion happens through gold falling, silver rising, or some combination of the two is a question reasonable analysts can debate. That the ratio has been unusually stretched is not seriously in dispute, and its recent narrowing is itself part of the story silver has been telling this year. None of this, I want to be clear, constitutes a promise. Silver has earned its reputation as the more excitable sibling of the precious metals family precisely because it does not move in straight lines. It is a comparatively thin market by the standards of global finance, and thin markets are prone to overshooting in both directions. The same deficit dynamics and rate sensitivity that have propelled silver from the $26 lows of August 2024 to the low 60s today are equally capable of producing sharp, disorienting pullbacks when sentiment turns, as it did earlier this year when the metal shed a substantial portion of its January peak within a matter of weeks. Anyone who has followed this market for more than one cycle has watched it deliver both euphoria and humiliation, often within the same calendar year. What makes the present moment worth your attention, then, is not the certainty of further gains, but the convergence of forces that rarely align this cleanly. A structural deficit now entering its sixth consecutive year. A supply chain that responds to years, not headlines. An industrial base, solar installation, electric vehicle production, data center infrastructure, advanced electronics, expanding its appetite for the metal even as some manufacturers experiment with using less of it per unit, and an investing public increasingly willing to treat physical scarcity as a form of insurance against a financial architecture it no longer takes entirely on faith. These are not the ingredients of a single news cycle. They are the ingredients of what economists, when they permit themselves a little candor, call a regime shift, a period in which the old assumptions about how an asset should be priced quietly stop applying and nobody rings a bell to announce it. I would gently caution against treating any of this as a reason to abandon judgment. Markets that run on genuine scarcity are still capable of running too far, too fast, and silver's history is littered with cautionary tales for those who mistake a real story for a guaranteed outcome. The Hunt brothers' catastrophic attempt to corner the market in 1980 remains the standing monument to that particular species of overconfidence. The lesson of that episode was never that silver's fundamentals were false. It was that even a true story can be ridden past the point of prudence by those convinced they alone understand it. What I would ask you to hold on to as we move into the final portion of this discussion is a distinction that gets lost amid the noise of price targets and comment section predictions. The difference between watching a chart and understanding a market. A chart tells you where the price has been. A market, this one in particular, with its deficits, its byproduct supply constraints, its dual identity as both industrial input and monetary refuge, tells you why. The final part of our story concerns what this convergence might mean, not merely for the price of an ounce of silver, but for the broader question of how the physical world is being repriced after a long stretch in which digital promises were treated as though they required no material backing at all. There is an old habit of mind, common to every generation, that has lived through a long stretch of prosperity, of mistaking the convenience of the moment for a permanent feature of reality. For the better part of 2 decades, a great many capable people were persuaded that value itself had become, in some meaningful sense, dematerialized, that wealth could be conjured, stored, and transferred as pure information, with the underlying physical world serving merely as a kind of scenery. Silver's return to prominence is worth dwelling on precisely because it is such an inconvenient rebuttal to that assumption. You cannot photograph a circuit board into existence. You cannot compile a solar cell. Somewhere, an actual mine operated by actual people, subject to actual geology, must produce an actual quantity of an actual element. And if the world wants more of that element than the mines can currently deliver, no amount of clever software changes that fact. This is, I think, the deeper argument silver is making at $62, whether or not the traders bidding it up there could articulate it in quite these terms. It is a reminder, issued not by a pundit or a policymaker, but by the impersonal arithmetic of supply and demand, that the physical substrate of the modern economy still matters enormously, and that a long period of taking it for granted has left certain corners of that substrate quietly, structurally short. Silver is hardly alone in this. Copper markets tell a similar story. So do certain rare earth elements essential to defense and electronics manufacturing. But silver's story is the most legible, precisely because it sits at the unusual intersection of 2 very different kinds of human need. The ancient need for a store of value immune to the failures of paper promises, and the thoroughly modern need for a conductor efficient enough to power an electrified, digitized, increasingly automated civilization. Consider what this dual identity implies for the different constituencies now watching this market with unusual attention. The investor holding physical coins or bars is, in a sense, making a statement about institutional trust, a wager that when currencies are managed imperfectly, as they always eventually are, something that cannot be printed retains its claim on value. The solar manufacturer, watching input costs climb, is making the opposite calculation. How much silver can be engineered out of a panel before performance suffers unacceptably? A process that takes years of research and offers no guarantee of full success. The mining executive, weighing whether to greenlight a new project, must gamble on prices holding steady across a permitting and construction timeline that can easily stretch beyond half a decade. And the policymaker, charged with an energy transition that depends on precisely the technology silver enables, must reckon with a raw material constraint that no amount of favorable legislation can immediately resolve. 4 constituencies, 4 entirely different incentives, all now converging on the same finite pool of metal. It would be a mistake to read any of this as a prophecy of ever-rising prices. Markets correct. Silver, in particular, corrects with more enthusiasm than most, as anyone who watched it retreat sharply from its January highs this year can attest, And there is no law of economics that guarantees the current deficit persists indefinitely. Higher prices are, after all, the very mechanism by which markets eventually summon new supply and discourage marginal demand. However slowly that mechanism operates in a metal, this geologically stubborn. What can be said with somewhat greater confidence is that the forces driving this particular episode are not the froth of a single enthusiastic news cycle. They are structural, a multi-year deficit, a supply chain bound by geology and bureaucracy rather than sentiment, and an industrial appetite tied to trends, electrification, digitization, the build-out of energy infrastructure, that show no sign of reversing on any timeline relevant to an investor's decision-making. I will confess a certain sympathy for those who feel they have arrived late to this recognition. Silver spent a great many years being treated as an afterthought, gold's poorer and more excitable relation, tolerated by serious portfolios mainly as a hedge against a hedge. That era of polite indifference appears for now to be over, and the natural human response to having ignored something for years, only to watch it move decisively without you, is a species of regret that market veterans know intimately and would counsel you against indulging too heavily. Regret is a poor advisor. It tends to produce exactly the kind of undisciplined, late-cycle decision-making that turns a legitimate structural story into a personal financial misadventure. What I would offer instead, as this discussion draws to its close, is not a prediction, but a discipline. Pay attention to the inventories, not merely the price. Watch what the Silver Institute and comparable industry bodies report about the deficit each year and whether it narrows or widens. Watch whether above-ground stockpiles continue to be drawn down or whether recycling and new mine supply begin to catch up. Watch the gold-to-silver ratio, not as a magic number but as a barometer of relative sentiment. And watch, above all, whether industrial users are managing to thrift their way out of dependence on this metal, or whether, as the evidence currently suggests, silver remains stubbornly difficult to engineer around. These are the indicators that will tell you whether this comeback has legs considerably longer than the ones already displayed, or whether it has already run most of its course. Silver's history is, in the end, a peculiar kind of mirror. It has reflected, across 5 millennia, whatever anxieties and ambitions a given era happened to be carrying. Monetary anxiety in the era of the gold standard's collapse, industrial ambition in the era of electrification, and now, it would seem, both at once. That a metal this old should find itself, in the summer of 2026, standing at the exact intersection of humanity's oldest financial fear and its newest technological hunger, is not a coincidence worth dismissing. It is, if anything, the most honest kind of signal a market can send. Not a shout, but a long, patient accumulation of pressure that finally found its exit. I would be genuinely interested to know where you come down on all this. Down in the comments, tell me plainly, do you believe silver is still meaningfully undervalued relative to the structural deficit and the industrial demand behind it, or do you suspect the market has already done most of the repricing it needs to do? Say so and say why. The disagreements in that comment section tend to be more instructive than most of what passes for analysis elsewhere. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in